Something happened recently with regard to stocks and bonds. It may impact the way you invest or not. Let's take a look. Recently, the yield on the 2-year Treasury increased where it is now above the dividend of the S&P 500. The last time the yield spread was this generous in favor of bonds was back in December 2007, which, as some traders still around may recall, is when the last recession officially started. Now, there is one difference. Back in 2007, the yield on the 2-year Treasury was declining, whereas today it is increasing. And again, it is now above the dividend yield of the S&P 500. So today, let's take a look at some stocks that still have their dividend yields that are higher than the 2-year Treasury. Overvalued stocks and rising interest rates suggest that bonds might now be a better investment. But there's still a strong argument that shares of well-established companies with attractive dividend yields are much better long-term investments than bonds. And this list here from MarketWatch shows you some very strong companies that have very decent dividend yields. At the bottom of the chart, you can see Federal Realty Investment Trust has a dividend yield of 3.14%, and it goes all the way up to the top of the list where AT&T has a dividend yield near 5.93%, just under 6%. That is very strong. Now today, let's just take a quick look at one of these companies, PepsiCo, with a dividend yield of 3.25%. Money managers use all sorts of complicated analyses and charts to explain why you should invest in or avoid a particular company. But if we compared shares of PepsiCo to the 10-year U.S. Treasury note, Pepsi recently had a dividend yield of about 3.25%, while the recent close on the 10-year U.S. Treasury is about 3.065%. So if you go with Treasury notes, every year you'll get just above 3%. And at the end of the 10 years, you're going to get your money back. With Pepsi, and of course there's no guarantees, you can be reasonably assured you'll get your dividend increases each year. And that's only considering the income from the two investments. After a handful of years, you may be well ahead with Pepsi because of dividend increase, and it's reasonable to assume or expect that at the end of 10 years, you may well have more principal from your original investment in Pepsi than you would from your 10-year Treasury note. Pepsi has raised its dividend every year for at least 25 years. Of course, there's no free lunch for investors because if you hold dividend stocks, you may well have to put up with some price volatility, as we know. But if you are investing in Pepsi for the current yield of nearly 3.3% with the expectation of income growth, you should not be as concerned with the near-term volatility. If Pepsi goes down, say 50% in value from today's price, your income is not going to change. And it's also important to note that shares of companies that consistently raise dividends are typically better performers over time than non-dividend paying stocks. The increase of a dividend is the most tangible statement that management and its board of directors can make about the confidence in the current and future fundamentals of their company. So now let's take a look at the charts for Pepsi. This is the 20-year monthly chart on Pepsi, and the symbol is PEP. And for disclosure purposes, I do not hold any positions in Pepsi at this time. The recent close was $111.32. And looking at the price chart, we had a bottom here in 2009 and a recovery, and on we went here. We had this correction early this year to this point here, and then we popped off the bottom. We're now just riding above the 20 EMA. But I'll show you here in a second that I think we're going to actually have a better position, price position coming up. So I wouldn't necessarily enter Pepsi right now. So let's take a look at that. What we can see here from the MACD chart is that we had the bottom here and then the slight rise with a curve. And I think this is going to create a little hitch, kind of like that. Somewhat like this very small one at that time frame and this much more subtle hitch at that time frame. Let's go back up to the price chart so that you can see exactly what I'm talking about. So at this point in here, here's this little hitch. You can see that we had the price bottom there, and then we came up, and then we came back down just a little bit. There was a higher low in the price, and off we went. Here is the same thing. We had the bottom. We had a much more subtle hitch, but it still is one nonetheless. Came back down there, and then we had a higher low, and off we went. So I'm expecting the same sort of thing. I think this price is going to come back down here, say toward that 50 EMA, and then set a higher low, and then off we go. And into the histogram, you can't really see much from that. The price rate of change, at least it's bottoming to some degree. And into the relative strength, much the same. The bottom here, we're above the 50. Into the stochastics, you can see that hitch at that point in there, and then you can see it a little bit more pronounced here. There is even one here, but I don't think that really showed up too much in the price. But I do expect something of a similar fashion to occur here as it did here and here. So watch out for that. Not quite time to buy. And the Williams is not really showing us too much. Back up to the price chart. So you get a good idea again of what it's done over this time frame. So now let's go take a look at the 2-year weekly chart. This is the 2-year weekly chart on Pepsi. And as we can see, we had a bottom here in May with the rise that came up to that point there in August and then a slight retrenchment. And I actually believe that this consolidation is going to drop further in price, probably below that $100 a share. And I'll show you why. Here we see the MACD. You can see that the MACD is weakening and it looks like it's going to turn over with a fast line, I would say, moving through the slow line here in the next few weeks or so. You can see that forming here in the histogram. Definitely had a top and then on down we go. You can see the same thing here in the price rate of change with the fast line moving through the slow line just recently. Relative strength is weakening, stochastic as well. Volume's not saying much. And then, of course, the Williams is heading on down. So if you're interested in Pepsi, I would not buy at these current levels. Just wait and see for a few weeks into October, I would imagine, and just follow your charts and you'll have a better idea and hopefully a better price. But of course, I cannot give you any guarantees. So for today, that's ChewDog Charts. Thank you.